Hi there, my name is Anatoly. I work as a dealer in D2 Broker. In this video I will speak about some key crypto indicators which proved to be quite popular within the community, and also I would like to emphasize specifically on how easy it is to get access to unique data which is available only on crypto markets, which you will unlikely to find on traditional assets like equity, for example, and how you can use it to your advantage. Now let's dive right into it. One of the main advantages of crypto and blockchain in general is that a lot of information about transactions, and actually basically most of the information about transactions, is stored in a single database called ledger, and access to the database is basically free. What this gives is that using this data you can build indicators and extract data which you can do using some traditional assets like, for example, equity. The main purpose of this video is to go through some of the main and most famous models on the market and show how you can get this sort of data and build your own. The first model we covered is SOPR, or also called Spend Output Profit Ratio. The idea is as follows. Because Ledger stores data on each transaction and the price at which a person got rid of a certain amount of tokens, and those tokens were received by a different person, we can, at every single point in time, we can basically say how many people are in profit or in loss, depending on the current price. SOPR basically does that. The main use of SOPR is to highlight the potential bottoms of the market, because at least historically, when the value of SOPR dropped below 0.8, for example, quite often it would indicate the beginning of the upward movement. Why does it work? Well, it works because psychologically people are less reluctant to sell when they are losing money, when they are in profit. And the main idea behind SOPR is that whenever there is a correction on the market, at some point we will come to the state of the world when people are at a loss, but everyone who wanted or had to sell Bitcoin already did so when the price was higher. And at current prices, they're just basically people who are at a loss, but they are ready to hold their tokens, they're not willing to sell them. Quite often, those people will be ready to hold those tokens if the price goes even below. And once we come to this state of the world, basically the demand for selling crypto becomes very small, and this pushes prices higher. The next model on the list is CVDD, or Cumulative Value Days Destroyed. So the idea is that because in Ledger we know the time at which transaction occurs, we can calculate basically how many days each person holds tokens on their wallet. For example, if I buy 5 Bitcoins and hold them for 5 days, if I multiply 5 by 5 here, I get 25 of basically some abstract value, which in CVDD formula is called coin days destroyed. Why do we need this value? The idea behind CVDD is that whenever there is, for example, correction on the market, at some point we arrive to the state of the world when all the people willing to exchange their tokens, basically to sell them to the new buyers, to the new investors, becomes very large. And we arrive to the point when old investors who, for example, held Bitcoins before the correction, basically transferred them to the new investors. This, at least in theory, should drive the situation of the market to the point when people are not willing to sell anymore and price goes higher. So to some extent, the idea here is similar to SOPR, but instead of tracking down the P&L of users in the network in general, we basically track how fast people transition people who held tokens for a long time transition them to the new investors, which potentially might be the driving factor for the price to start to go higher. And basically, at least historically, CVDD quite well pinpointed the bottoms of the market. Of course, it is a statistical model and it's all historical data. It might not work so well in the future. So talking about crypto indicators, it's probably impossible not to talk about stock-to-flow model, which is one of the most famous models on the market. Especially lately, there has been quite a lot of criticism sent towards this model, but I first will cover in short what this model is about and then talk about the criticism. So in short, because Bitcoin is an asset which has limited supply, just like, for example, gold or some alternative coins, Bitcoin has a very fixed number of coins which can be mined with time. This sort of enlists Bitcoin into the category of assets who have scarcity. Basically, the assets where the very scarcity of this asset could drive this price. And this is basically the main idea behind stock-to-flow. Because asset is rare, it has value. How does this model work? Basically, the people took the ratio of stock, basically the total supply of Bitcoins, historical, so how much we have now, a week ago, days ago, months ago, etc. And divided it by the annual growth in supply. They used this ratio and built a statistical model based on it. Up to now, this model has been quite good in outlining the sort of the channel of prices at which Bitcoin could move at each point in time. This model is basically all about explaining why Bitcoin should grow with time due to its scarcity, due to its limited supply. At least statistically, it works very well. However, there has been quite a lot of criticism. For example, the fact that this model doesn't include derivatives market, which has been quite large. Some people claim that there is a problem with so-called co-integration. The idea here is that the problem with modeling Bitcoin in general is because historically, up until now, it has been growing very aggressively. And whenever you try to explain a very aggressively growing instrument asset with an indicator such as stock-to-flow, which also naturally grows with time, because if you just look at the formula of stock-to-flow, it should become obvious that the value of stock-to-flow just grows with time, and there is basically no reason for it not to do it. And basically, when you try to explain an exponentially aggressive growing instrument with a statistical parameter which also grows with time, you run into a problem of co-integration, and this is bad for the model. However, regardless of all this criticism, the model has performed quite well, at least up until now, and many people monitor it and pay attention to it. Last but not least is, when talking about crypto indicators, it's also very important to at least mention hash rate. Hash rate is not actually an indicator which you get from ledger, for example, just like stock-to-flow, but it is very important if you, for example, you're very new to crypto markets and you want to start monitoring sort of graphs. Hash rate is basically an indicator which shows the general health of blockchain, of the system. Hash rate basically measures how actively miners operate the system, create new blocks, process transactions. And the more active they do it, the better it is for the system, the safer it is, and the faster it is. How well does hash rate predict the price of Bitcoin? Not very well, at least in its raw state. Some people try to build indicators based on hash rate, but regardless of how bad or good the predictive power of hash rate is, it's definitely a very important fundamental indicator for this market, because it generally tells you how secure the network is at each point in time. In conclusion, I would like just to outline some key ideas I wanted to introduce with this video. The main key idea is that, as you can see, a lot of information in blockchain is very open for use. It's not some kind of secret data which you can't access without paying a lot of money or putting a lot of effort. Ledger is basically an open source. You can get this data, you can look at it, and you can build your own indicators, whether you want to use them for trading or just for research. This is probably the main message of this video. But just not to give some false expectations and just to give a word of warning, be very careful when you start to look at certain indicators, especially the ones which are trying to make you believe, explain why a certain asset should definitely grow with time. Such models might have a lot of bias and they might have some fundamental flaws, which is not necessarily true, but it's just a word of warning to be careful about such models. Nevertheless, there is a lot of data has already been digged out and used to build such indicators, and there is a lot of data and potential new implementations for it which can be employed. I hope this video was interesting for you, and have a nice day.